Everybody knows how I feel about it, but I think that you should make your own educated choices. So that's what we're going to talk about, all the different ways that you can buy gold, and you have to determine what makes the most sense for you. I know what makes the most sense for me, but let's just dive right in. Because quite frankly, the average daily trading volumes, well, guess what? Gold is the second most traded intangible asset because they're trading contracts. That's the spot market. We'll get more into that in just a second. But gold liquidity includes estimates on over-the-counter transactions, so OTC, and published statistics on futures exchanges and gold-backed exchange-traded products. All of these are intangible. My personal preference is tangible, because if you don't hold it, you don't own it, regardless of what your perception is. So that takes us to the spot, because the spot market really only reflects trading demand. That's it. So here is the most current spot market chart that I pulled on 6/27/24. And people might be saying, well, why is gold going down? Why is silver going down? Because it was a little overbought on a technical basis, but still remains severely undervalued. So back in October, it was at 1823.50. Guess what? Hit a new high April 2024, and then again, right? So it's broken out and it is simply correcting, because what you're looking at here are the moving averages. So what they do, there's your short-term cup, but every day they total up where gold closes for 200 days and then they give it an average. And they do that also for the 50-day moving average. 10% away is a lot. It's still, even with this little bit of a correction that it's had, it's still 12% away. So think of it like a water skier. There's only so far one way or the other that you can go behind that boat that's driving you before you come back to center. But that's just technical. They can create as much gold as they want to. That does not nor ever will exist. So now we've broken below the 50-day moving average. It's not a big deal. I don't personally really even care that much about spot. I only do because you do. But another way, and this is designed to move along with spot, is the ETFs. And a lot of people go, well, I'll just buy GLD and then I'll own gold. No, you don't. You own shares in a trust. So let's look at that, because what GLD actually is, or any gold ETF, or silver ETF for that matter, is a diminishing asset. The red line is spot, the blue line is GLD, the net asset value of GLD. It is designed to mimic the spot market. That's purely what it's designed to do. But you can see where the blue and red line converged over here, and then over time they started to separate, and now there's a pretty wide separation. That's because they sell off holdings on a daily basis to pay their ongoing fees. You do not own or have access to the underlying metals. And it is, as I said, a diminishing asset. But what's particularly interesting that's happening right now in the spot market, typically the ETF flows, money going in, money going out, can determine the spot price. But guess what's happening now? There is a divergence, and we are seeing the spot market continue to go up even with heavy GLD sales. That is a pattern shift. That tells you that there's something more that's happening in this market than just kind of meets the eye. So definitely pattern shifts are key, but why is that happening? Because demand is exceeding that supply and even overwhelming the ETF's ability to control that spot market. I think that's extraordinarily interesting and extraordinarily telling that there is something more that is going on here than meets the eye. But here's something else that goes on that you're not really seeing at all, and these happen to be the notional derivative contracts, the derivative gold contracts in the FDIC insured banks, right? Look at 2023. This is 2023. This is the full year for 2022. But in 2023, they had so much buying and selling of these contracts that it dwarfs anything and is easy to manipulate the prices. People always want to know, well, why is gold going down? Why is silver going down? Because they can create as much gold and silver that does not nor ever will exist as they want to, and it is cheap. It is cheap and a leveraged way to control the price and keep you blind to what's really happening. But make no mistake, look at this. When they put the full year for 2023, that's off this chart. They're going to have to recreate this chart and make other things look dwarfed because of the level of contracts in there. Gold derivative contracts are not physical gold, but the markets read it as if there's all of this gold that exists, and that pushes the price. Another way that you can approach it is through miners. Now, miners, that's really a corporation. And so you don't own the underlying gold either, but you do have some of that, but you have also the expenses and the choices that the miners make. What I'd like to point out in this case is this wedge, like a wedge of cheese. And when you get close to the end, in this case, there is a break above, which means that this index is more than likely to continue to go up because of this technical breakout. But make no mistake, you don't own the physical gold.